another strong showing for the banks in today's market rally, and the financials have been on fire. The financial spider ETF, the XLF, now at more than 12% over just the past week. Our next guest says this is an optimal time to be betting on the banks. Mike Mayo is a senior bank analyst at Wells Fargo Securities. He joins us on the CNBC Newsline. Mike, always great to speak with you.
Thanks for having me.
You cited green shoots in your note. You cited the employment report on Friday. Also, you had a separate note citing some data on consumer credit and lending from the Fed as green shoots. But I'm wondering how sure you are that these shoots will actually blossom into plants, to use your metaphor, given the uncertainties in the economy.
Well, look, in no uncertain terms, we remain buyers of banks. We increased targets on every large cap bank that we covered last week. Banks are among the leaders this quarter in terms of stock price performance, and we expect that to continue. Look, on the one hand, these are sobering times. I mean, unemployment is over 10%. There are bankruptcies. We still have loan losses increasing, 2 to 3 times. It was earnings hell in the first quarter. It's probably earnings hell in the second quarter. But the way these banks are still priced, I mean, they're still priced like it's the global financial crisis, and that's a complete disconnect to the stock market as a whole, and frankly, it's a disconnect to what the bond market says about banks. The bond market says, banks are as safe as the average corporation, whereas the stock market says, hey, they're in big trouble. So at the same time, you have these green shoots. You had the jobs report. You have new data from Friday night that shows consumer loans increased week over week in the banking industry for the first time since January. So you have that. You have less requests for loan deferrals. You're seeing pay downs of those March loans that were made by the banks. Consumer spending is improving. So what we'd say is it's less bad, less chance for the recovery to be, an L, a W, a Nike swoosh, a backward check mark, or whatever you want to call it. There's less chance for that extreme tail risk. And at the same time, anyway, banks are resilient and are able to absorb the body blow and still grow book value and still support the economy. The other bit of information in the Friday night report from the Fed is that banks have lent $700 billion of new loans. That's 7% growth in the banking industry's loans year to date. So this time banks are not the problem, as they definitely were in the global financial crisis. This time banks are part of the solution.
Hey, Mike, it's Dan. Quick question. You seem to really love the money center banks, Citibank, Bank of America, JP Morgan. I find it interesting that they topped out the first week of January, and they were obviously the hardest hit within the banking sector. Why is it that they really underperform from their highs relative to, let's say, the investment banks like Goldman Sachs and Morgan Stanley that are only about 12% off their Q1 highs?
Look, you can't ignore the fact that the rate environment is still awful, okay? I mean, this is really bad, and so the money center banks have more loans than the pure play brokers like Goldman Sachs or Morgan Stanley. So that would explain that. Having said that, as we start seeing green shoots, as you start to recover, and as you go through this crisis period, you're really seeing the value of scale. Goliath is winning. And Goliath is winning more than ever before during this crisis period. So compared to plain vanilla banks, Citigroup, which is our top pick by far, followed by Bank of America and JP Morgan. First, they have half fee revenues. And by the way, capital markets are doing quite well, better than people expected, and far better than implied in the Fed stress test. And the other thing is, and this is really exciting as a bank analyst, are the share gains of the largest banks due to technology. Retail customers have been jolted out of the bank branches and forced to use digital banking. This is the customer choice, but that's going exactly where bank strategic plans have been going. So in the last 2 months, you've accelerated the digital acceleration of the banks by like 2 to 5 years, and the best digital players are Bank of America and JP Morgan, and actually Citigroup's moved up here recently too.
So just one quick follow-up, though, Mike. Is there a chance, though, that this lack of performance from the highs. I know they've done very well from the lows. Suggests that the back half of 2020, though, might be a much tougher slog as it relates to capital markets, as it relates to bad debt, as it relates to just a whole host of things where they touch the economy in a much broader way than some of these other sectors that have come back right to their prior highs.
Well, yes. I mean, we have loan losses increasing 2 to 3 times. We have capital markets falling off from the first quarter level. We have net interest margins under pressure. That's in our estimates. Even with that, we see these stocks with, a decent upside of 1/4 to 1/3 over the next year. I think what the market's missing is this is not 2008. This is 2020 when you've had a decade of increase in capital. Capital's twice as much as it was before. You've had a decade of Fed stress tests. You have a lot more liquidity than you had before. I mean, this is, you know what it is? It's just recency bias. Investors act like the global financial crisis was yesterday, and they're giving bank stocks those valuations. So, yeah, they're priced like someone's going to blow up. By the way, you had a mini stress test in March, and look at the performance of Citigroup, Bank of America, and JP Morgan, and for that matter, even, Goldman Sachs, too, and Morgan Stanley. They all excelled during that period, and really being part of the solution this time.
Mike, always great to speak with you. Thank you.
Thanks for having me.
Mike Mayo of Wells Fargo. Guy Adami, I'll go to you on this. Your thoughts on the banks?
Well, I mean, as bad as I've been broader market, one thing we've gotten right has been the banks. And, when JP Morgan was in the 80s, the bull case we were trying to make is, look, they just told you tangible book was $62. The right multiple in this environment is probably like 1.8, 1.85, and that gets you a $115 stock. And lo and behold, basically here we are. So I'm with Mike in terms of the banks not being the problem. I've never suggested they were. They've had a big run, and my sense is they probably have some more room to the upside. So I'm with Mike Mayo on this one.